Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Steve Sosnick, Chief Strategist at Interactive Brokers, as well as Phil Mackintosh. He's a Chief Economist at Nasdaq. We also have Managing Directors on our Nasdaq Market Intelligence Desk, Chris Dearborn, Max Cabasso, and we'll have Brian Joyce, our technician, joining us remotely. Gentlemen, it's great to see you as always, and apparently some news this afternoon. Phil, rates staying unchanged, but the move in yields, 20 basis points is a lot in a short amount of time.
And it's kind of weird because the market was already pricing in a lot more cuts than the Fed had said, but the Fed came out and said, actually, we're talking cuts. And so then the market's now going down even faster. And if you look at historic rate change environments, like we talked about how this was the fastest rate hike in a long time, you don't usually have slow rate falls. So it'll be interesting to see how this all actually plays out.
Yeah, I mean, Steve, you and I were talking off camera with the guys. Is too much of this priced in?
I do think so. I mean, I think that they acknowledged in the dot plot that we're looking at 3 cuts sometime in 2024, but the market still has between 4 and 5 priced in. So somebody's still out over their skis a little bit. And I do think that's the market. I do think we've gotten very bulled up, somehow very bulled up about rate cuts, but without being concerned that they might come about because of a weaker economy. It's sort of the dream scenario, but let's see if this can actually play out as planned.
Yeah, and Chris and Max, it's interesting because you talk to our issuers, our Nasdaq listed companies all day long. Clearly, cost of capital starts to come down, interest rates start to come down, kind of makes a difference, especially for smaller cap companies. What are you hearing from your issuers?
You're hearing a number of different items. Everyone 3-4 months ago, especially coming into October, a lot of the issuers, especially the smaller cap companies that are operating at a cash burn, were concerned about raising capital, and the cost of raising capital is going to be extremely expensive, and you have to forecast for that. So now you're looking at a much lower cost of capital raise. Do you have to raise money in the open market? If you're going to have to do a secondary, how many shares are you going to have to do? What's the dilution going to be to the existing equity, especially if you're a cash burn company? You're not going to let go for debt. You're going to have to issue shares. So now this environment, especially on a rising market across the board, might better be a little bit better. You need more than just a couple of minutes to take a look at it right now. It's really kind of the knee-jerk reaction. I'd like to see what happens over the next 3 or 4 months. We're looking at a March cut right now, 60% out of the gate with the Fed fund futures already adjusting for that. So, and in 1 year's time on the Fed fund futures, they're betting at a 4%. That's more than 3 or 4 cuts. Unless we're going to do half basis points.
Yeah, but Max, you don't want to make the mistake, and we've spoken about this before, where we saw the velocity of how quick rates were raised. You don't want to make a mistake on the way down. I mean, we've learned some historical lessons from that.
Yeah, for sure. Some of the folks I was talking to, I have a friend that's a corporate attorney, does a lot of restructuring. Anybody that has floating rate debt from 21, or anybody that has anything that need to roll in 24, 25 maturities, they're all looking now for short-term solutions. They're really not trying to plan anything out for long-term. They say, okay, how do we get through these next 2 years? And it's a lot of the capital intensive sectors, the biotech, telecom, even crypto was in trouble for a while. But again, they're looking really short term. How do we get through these next year or two and then worry about it later when they hopefully long-term rates are much lower and they can lock in. But right now they're really short term. Are you going to issue debt, or are you going to maybe have a secondary, issue some more stock? Maybe it'll be a little smaller than you had previously thought because you expect to be able to tap the credit market again shorter. But again, they're really looking at the short-term window. How do we capitalize here, get some cash, keep us going for a bit, and then worry about the long-term later.
Yeah, and then Steve, speaking of small caps, market concentration, that's another area. So goes the Magnificent Seven, so goes the market, but it's broadened out a bit recently.
It has, and I think that's very healthy. Is we needed to see some rotation. You can't have a market where you're really driven by 7 stocks. Anytime we've had very, very narrow leadership historically, it's ended badly because ultimately people get over concentrated in those names, and if you try to run for the exit in some of those names, out you go. And when you think about it, depending on what index you're indexing to, 25% of your money or 40% of your money or 50% of your money is going into those 7 names, whether you're thinking about it or not. And so that really, there's a sort of a feedback loop. And the problem is if you see underperformance that's not met by rotation into the sectors that are underperforming, say the other 93 stocks in NDX, that can be problematic. But we did actually see, particularly this week, a big rotation in the other 93, so to speak.
Yeah, oh, well, and that's a perfect segue for us to bring Brian Joyce in. He's Managing Director on Nasdaq's Market Intelligence Desk, as well as our resident technical analyst. Brian, let's take a look at a couple of charts here. Let's Nasdaq 100 being one of them.
Hey, Jill, thanks for having me. So the Nasdaq 100, we can see it's roughly about 1.5% from its all-time high. So we've certainly had a nice move here since the bottom in late October. We're up 7 out of the last 8 weeks or so, and so that level, when we approach it, which we are doing right now, I would expect some near-term backing and filling. Maybe that's something we see in January. I know we were talking about the breadth, so if you look at the Nasdaq 100 equal weight index, it's just beginning to break out of a pretty significant range as well. It's about 6% away from its all-time highs. If we look at a ratio of the Nasdaq 100 over the equal weight index, we can still see, since November 10th, when this ratio peaked, which represents outperformance by the cap-weighted Nasdaq 100, it's been in a downtrend now for roughly 4 weeks, but you can see the longer-term trend is still, favoring that move to the upside. We're well above that 200-day moving average. So at the moment, it does, we are seeing some early signs of the equal weight beginning to take over the performance. We do want to see a longer-term trend of that. I just want to give a quick hat tip to the Dow Jones Industrials, which is the first major U.S. equity index to break out to new all-time highs that are happening today.
And Brian, do you have a side-by-side comparison of the Qs and the QQQE, which is the equal weight? I mean, you could, say the same thing about the S&P as well. You're starting to see, the equal-weighted ETFs outperform.
Yeah. So so we look at the Russell 2000, which is a much broader index, much lower weightings for each member. We can see there that, this index looks very different. It's still about 17-18% away from, its all-time highs. And we're still, in the middle to upper half now of the, sideways trading range that it's been in since June of 22. So about 18 months or so. So, there is very different amongst the equal weight versus the cap weighted. Again, you guys mentioned the Magnificent Seven. That's a big reason for it. So we are starting to see that turn where a lot of these underperforming, much lower valuation stocks and sectors and industries, particularly if you look at the regional banks, look what's going on there in regional banks today. Those are the poster child for 2023 of underperformance. Those valuations are dramatically lower. So looking ahead, if we think the rate hike cycle is in the rearview mirror, for banks, that's a very good signal for, net interest income, deposit beta, their funding costs, and those valuations were extremely low levels this year. And I think we're just beginning to see bigger institutions now really beginning to step in, looking longer term out and seeing maybe, these are, really good investments for the longer term. And, maybe so that rotation, as your panelists referenced, rolling from the higher valued, better performing stocks into other areas that may benefit from the future changes in the rate cycle. Certainly regional banks could be one of those groups.
All right, Brian, appreciate the insight as always. We'll catch up with you again tomorrow. Thanks for joining us. Phil, would you agree that valuations overall are looking, or are they still attractive?
I mean, definitely if you look at the mid-cap and small-cap versus historic normals, they're looking cheap. But even if you look at the S&P 500, I mean, the valuations of the Magnificent Seven look relatively expensive, but one of the things that's different to the last time we had a big inflation in tech sector is they have real earnings, they have really good margins, so they're not the same kinds of companies. They actually deserve a better PE. Overall, the market looks a little bit rich, but what it looks like is it's got a bit ahead of itself. It's already thinking rates are going to come down. It's already thinking earnings are going to recover. So it'll be interesting to see over the next 6 to 12 months if that actually materializes, what it will take to get the market to then take another leg up.
Is there a seasonal trade here, Steve?
Well, you have the typical Santa Claus rally into the end of the year. I think, my concern was that Chairman Powell might play Grinch ahead of Santa Claus, but not apparently doing that today. One of the things that scares me a little bit is I think we've got such positive momentum going into the end of the year and such the unanimity that things will continue. It's set. I do have this weird reflection back to 2022 where we peaked, pretty much on the first trading day of the year and never looked back. I hope that's not the setup here, but I do think we're in from a seasonal point of view, looking for the next couple of weeks. It seems to be smooth sailing ahead, thanks to the chairman.
I do share your thoughts around the contrarian trade here. We spoke about this back in August. Everybody was bullish. You could not find a bear in any sentiment indicators. I mean, look what happened. It was almost like a self-fulfilling prophecy, based on the activity we saw in September and October.
Well, that's kind of what happens, and that's kind of my spidey sense, because I don't have anything really to put it on. It's just we're so bulled up right now. I talked to some of our guys who handle institutional accounts. I said, "Do you see anybody hedging?" And they said, "No, they're just buying. They're just buying index options and index calls and rolling them up."
Well, speaking of, we have major options expiration cycle coming up quarterly.
Well, and
I mean, does anything happen around options expiration anymore? It used to be a big event.
Well, now that we have expirations every day, they've certainly fallen in a relative sense. But this is still when you have the quarterly, the futures still have the quarterly cycle, the monthly and the quarterly cycles, and so there is a bit more to it on a major expiration. Plus, you have on quarterly rebalancing days, you typically quarterly expiration days, you often time those with rebalances, which among others is NDX, and so.
Yeah.
And so there is a little more that can happen on quarterly expirations than on your standard Friday or your standard Tuesday at this point.
Yeah, is liquidity getting quiet at this point?
No, just the quarterly and the actual OPEX periods are, the liquidity is just much better for them. I was talking to somebody on one of the banks on their derivatives desk today. Do you guys still care about it? Obviously, there's so much more in the weeklies and the dailies, but anybody that's putting on size positions, they said, anybody that's hedging their book, they're using those normal, expiry events, especially the quarters, to hedge your book, the liquidity, and it's not just for the investors, but for the banks themselves. If they're going to have to offload some of their positions, the interdealer brokers finding another position for them, for somebody else to take on that position, they're really not going to be able to offset it as well with some of the weekly and daily. So again, they do see a bit more concentration in these quarterly ones, just because the ability to kind of move it around and not have such a big impact. So it's still important. Now, again, it's much more well telegraphed than obviously in history, but those are still big events for them and big expiries and timing to look at for them.
Mm-hmm.
I mean, the Triple Witch and the Russell 2000 reconstitution are traditionally 5 of the highest volume days of the year, with most of the volume coming at the close. Last year was the December Triple Witch was the second highest volume day of the year. This year, and which makes sense. If you look at the NDX, we're looking for a $37 billion notional to trade for the rebalance. It could be even more now with the Take Two coming into it. So that's a lot of liquidity putting on top of the S&P the S&P rebalance and all of the other expirations. So if you're a major player and you're looking for liquidity without price slippage, this is the day that you want to trade at the close or in the after hours.
Yeah.
Liquidity is there and the price point is stable.
Well, Phil, from an investor perspective, whether it's a Nasdaq 100 or other indexes, does it mean anything for an investor with stocks coming in and out? What's the rationale behind the methodology?
Even a mutual fund manager is going to put stocks into their portfolio and take stocks out of their portfolio. The way indexes work is you listen to what the index provider says to do, and then you do it. But really, it's just making sure that the Nasdaq 100, in the instance that Chris is talking about, has the 100 biggest stocks, and the S&P 500 is most of the big cap stocks from the rest of the market as well. So, it's just making sure that what you think of as large cap in the portfolio is large cap stocks. So you need to do a bit of house cleaning. And actually, S&P is doing quite a bit of house cleaning on Friday, as well as the Nasdaq having its annual review. So it could be a much bigger close than we normally see in December. We normally do see just the Triple Witch close about 4 times bigger than a normal close.
Is there a trade around the index rebalancing, Steve?
Well, yeah, but it is a subtle trade. I mean, so for example, I think we saw people kind of front running it a little bit earlier this week when you had the semiconductors rallying and Nvidia without Nvidia, or you sort of had basically, like I said, the 93 stocks rallying and 7 falling. I think that was some people front running the NDX rebalance, because the relative weighting of the Magnificent Seven within NDX is going to be falling relative to the others, and I think that it was certainly helped by good news from Broadcom and some other things that boosted the semis, but it was kind of staggering to see a decent up day when you had the Magnificent Seven down, and very specifically when you looked under the hood. It was a very good day for a lot of tech stocks, many of which are going to be the ones that benefit from the rebalancing.
Yeah, I mean, you would think logically the stocks that are coming out, you would be buying the ones that are going in because managers have to buy it.
Exactly. But so the problem is that trade, these are well telegraphed trades.
Right.
So that, this is not like there's any, the average person doesn't have a lot of information edge here, because you've got multi-billion-dollar fund managers who are so keyed into the nuances of this, because think about if you manage an index fund, this is literally all you do and all you focus on. So it's hard to have an information edge as an individual investor or even a small institution that a big index provider doesn't have. So there is a trade. Yes, in theory, you probably want to lighten up on the stuff that's coming out and load up a little more on the stuff that's coming in. But bear in mind you're coming at it with maybe a little less knowledge in this case. And I don't like to suggest to people to do trades where they're at an information disadvantage.
Well, especially if the fund manager knows the methodology, they could probably figure it out on their own.
There's not as many shots on goal as well. Whereas, I've had these conversations frequently with our listed issuers, kind of looking at companies coming in and out and how they trade the week before and the week after, and there's seemingly no rhyme or reason. We've seen companies that are being removed that traded positively versus and added that are traded negatively, versus something like the Russell 2000, where you're getting 1,000 shots on net, 2,000 shots, essentially shots on goal. Hey, we're going to put this whole basket on. We have a feeling of where it's going to go. Some might trade the wrong way, but we're trying to, as a whole, we have enough opportunities that, okay, we might be able to, create a few bips of alpha. Whereas when it's 1 or 2 or 3 stocks and everybody sees the same thing, it's a lot tougher to make money on it, because, again, it's so telegraphed. We have the methodology. It's out there. It's not there's no investment committee. It's very standard. This is the process. Everybody kind of has an idea of what's coming in, what's going out. And again, there's 3 in, 3 out, 4 in, 4 out, versus in the others, again, the Russell, where you have way more shots, to get it correct, versus this, where it's really just 1, 2, or 3. So it's a lot harder in this sense, again, because of what's out there and the limited number of opportunities, versus something like the Russell, where there's a lot more opportunity.
But the reality is the market has got really efficient at doing this forecasting, pre-positioning the risk, warehousing that buy-sell trade for a long time. There's some new academic research coming out that basically says the profitability of the trade's almost gone for S&P 500 ads. So that's really good news for an index fund, because the liquidity is being provided at a really cheap price. And as Chris says, the market on close doesn't dislocate either.
All right, guys, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.